Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we're taking a little bit of a path, rather detour, and we're actually talking about a large cap, well-known bank, and that is IndusInd Bank. We've had some updates which are concerning, and that's also the reason why IndusInd Bank has actually taken a sharp knock down by as well over 20% on an intraday basis. We're going to cover a lot of aspects, but because this is KYC, we want to, as usual, start with what this particular bank does. So it was incorporated back in 1994, and the founder, of course, is Srichand Hinduja. The bank currently has about 4.2 crore customers, and it has a network of about 2,600 branches across the nation and well over 2,900 ATMs and cash recyclers nationwide. Now, in fact, IndusInd Bank, as being a part of the Nifty at one point in time, it's a bank which everyone knows about. And of course, a lot of our viewers could have potentially also banked to win IndusInd Bank. But in terms of its product mix currently, about 25% is a vehicle finance, microfinance comprised of another 9%, and of course gems and jewelry with about 3%. But most of it is still with corporate and retail banking, and that's as far as its operations are concerned. Let's move on and talk about the fundamentals of the company. So along with that, we consider the balance sheet, the income statement. In cases of banks specifically, we actually take up the balance sheet and then we consider the income statement. We also discuss the operational metrics and, of course, not to forget the asset quality as well. And then, of course, we move beyond the shareholding and talk about valuations, street credentials, and street coverage as well. So as usual, let me take up the aspect of the balance sheet. And in terms of that, firstly, we'll start off by looking at the advances and, deposits for the bank. And over a 3-year CAGR, it has done quite well. That should be up for you on your screen soon. Yeah, there you have it. So firstly, when it comes to advances, we've seen about a 17% CAGR. And deposits at around 14.5%. Are they spectacular? No, but they are reasonably strong in terms of the growth that we are seeing for this particular bank. And CASA also moving up around 10% in terms of CAGR. It has a reasonable capital adequacy ratio, but this one has come off quite a bit over the course of FY24 through the first 9 months of FY25. So it has fallen quite a bit. But do remember that the quarter gone by wasn't just that, but the quarter before that as well, had led to a lot of precipitation. And, there were a lot of challenges with respect to capital adequacy as well, among many other factors and challenges, which is why, this particular capital adequacy has come off to a certain extent. This is as far as the balance sheet is concerned. So, when it comes to some of these aspects, again, most of it is pretty steady, and we're giving it a thumbs up given the kind of size at which the bank currently operates in. So, which is why we felt that these operational metrics were good enough for this particular size. So, it's going to be a thumbs up there. Let's move on and talk about the income statement now. And when it comes to net interest income, that has also seen a steady 15% CAGR over the course of the last 3 years. Its operating profit has grown about 10%, but its net profit has grown around 45% CAGR. Why is this the case? Well, obviously, we're looking at the provisioning which has come off. So in terms of these metrics, the bank looks a lot more positive. And especially when it comes to your top line, that is your net interest income, growing at around 15% over the last 3 years. Of course, notwithstanding the numbers that we're seeing for 9 months FY25, that stands around 16,000 crores. Now, we are not entirely certain as to what it is going to throw up for the whole of FY25. And based on that, we could potentially see a little bit of a slowdown in the net interest income as well. And naturally, we could see a consequential impact on profitability, and hence your 45% CAGR could also be a little bit on the moderated end, towards the end of this financial year. And we're just about, well, 80, 90 odd days before we come to the end of this financial year, and we'll have a better idea of how IndusInd Bank does. That's, of course, notwithstanding the current challenges that the bank is currently facing. And, because of that, and we're going to talk about that in a lot more detail. In fact, that's the reason why we took this up on KYC today. So this as far as your income statement is concerned. We move on and talk about the operational metrics now. And with respect to costs of deposit, that's remained steady, but with a little bit of an increase in the third quarter of FY25, that stands at around 6.6%. Your net interest margins have also come off from well over the mark of 4%. It has now dipped to below 4%, 3.93 to be precise. And cost of income, again, rising to around 52.5% against 47.5%. So some of these metrics are not exactly, well, I would say, well, desirable. And return on assets has also fallen quite a bit. While we've given it a neutral stance right now, well, this is bordering on a negative right now. But we wanted to give the bank a little bit of a benefit of a doubt, of course, notwithstanding it's the latest that we've had. That said, let's talk about asset quality. Asset quality has certainly worsened. And we've seen at the end of 9 months FY25, we've seen gross NPA ratios rise to 2.25%. And for FY25, that stood at around 1.92%. Similarly, if you consider the net NPA ratios, those also rose to around 0.68% against 0.57%. Now, on an absolute basis, this bank is one in which, one might expect these ratios to be relatively higher, but they are not. We take that into consideration, but the fact that we are seeing a rise in NPA ratios is the reason why we're going to give this one a thumbs down. This is as far as its financial statements go. Let's go beyond, talking about this and perhaps address the shareholding as well. And shareholding has been very, very interesting over the course of the 1 year. While promoter holding remains steady at around 16.3, 16.5%, the FII holding has completely reversed. And in fact, FII holding has come down considerably, significantly over the course of the last 1 year. And well, as of December 2024, FII holding stood less than 25%. And when it comes to DII holding, that of course shot up. But naturally, if FIIs are selling in such large quantities, domestic institutions naturally will have a part in buying some of that bit, which is why domestic institution holding for IndusInd Bank has risen to around 42.4%. Well, based on this particular aspect, we're going to give this a neutral stance, a neutral rating on the shareholding. So this is as far as the banks are concerned. And now, want to talk about the valuations. Firstly, we must remember that the bank has corrected significantly over the course of the last 1 year. In fact, reducing by 55% in the last 12 months, which is why we are looking at the valuations at a significant discount to some of its other peers on the Nifty 50. So while IndusInd Bank trades at around 0.7 price to book, 1 year forward price to book, we are looking at HDFC Bank, Axis Bank and ICICI Bank, all of them trading at well above the mark of 1.5. And of course, for likes of HDFC Bank and ICICI Bank, over 2.5 times. This gives you an idea about the preference and the holding of shareholders as well, and whether or not they would in fact want to assign IndusInd Bank a higher price to book ratio, and that is certainly not the case. At this point in time, it does certainly look like it's an undervalued stock just based on its price to book. But there is a reason why the stock is in fact below the mark of 1. And for the many aspects that we are going to draw your attention to, notwithstanding the last 9 months and the kind of challenges that the bank has seen in terms of its earnings, in terms of growth, in terms of its asset quality and worsening asset quality. But of course, in the latest that we've had, the latest update that we're going to talk about in just a bit, where does that leave us when it comes to street credentials? As I was mentioning, that we have seen a sharp correction, a sharp 55 correction in the IndusInd Bank, as against Nifty Bank remaining flat over the last 1 year. So that's the other aspect here. So it's been a clear case of underperformance for IndusInd Bank. And, in the last 12 months, it's not the first time that has fallen well over 18, 19% in one single day. Now, we move on to talk about the street view. What is the street making of it? Well, I wouldn't make too much of what the street holds in terms of IndusInd Bank, because this very morning, we've had a whole slew of downgrades coming in, which is why, for now, we're just going to hold on to it. However, for now, given the updated calls that are coming in since morning, we now have more number of holds and sells as compared to buys. The total number of buys in the consensus stands at around 25%. On the other hand, if you take 17 holds, which doesn't make up for much, and another 7 buys, that comes out to around 24. So it's nearly 50-50 for those who are currently favorable and for those who are, well, on the fence to selling the bank. So, that's as far as the street view is concerned, which is why we're going to give this one a neutral stance as well. That brings us to the total rating of the bank based on what it has been. So if you consider how things have panned out over the course of the last few years in terms of its income statement, its balance sheet, its operating metrics and asset quality, moving on, if you consider some of the other aspects like shareholding, valuations and street coverage, overall, a lot of these factors are not boding well for the bank, and hence we're getting a substandard 4 out of 8 rating for IndusInd Bank. Now, this is as far as the ratings are concerned. And as I was mentioning, the reason why we wanted to take this up is because of the latest issue, the elephant in the room. And that is IndusInd Bank has found an accounting discrepancies in its derivatives portfolio, and this amounts to 2.35% of the bank's net worth. My colleague Vishwanath Nair is now joining us to tell us more. Vishwanath.
So busy morning for IndusInd Bank. Of course, during the trade on Tuesday, the IndusInd Bank stock has hit about a 20% fall in its stock price. This was largely because of a discrepancy that the bank has found in its portfolio, in its derivatives portfolio, which is likely leading to an impact of about 2,000 odd crore. Now, let's explain the story, how exactly it happened. Monday evening, the bank comes out with an exchange notification saying that it has found certain discrepancies in its derivatives portfolio, which will lead to a financial impact. This financial impact is estimated to be about 2.35% of the bank's net worth as of December 2024. The amount here works out to between 1,500 to 2,000 odd crore. And this will be taken as a one-time hit during the fourth quarter results whenever the bank announces them. Now, what exactly happened and what are these discrepancies? That's what we need to understand. The first step to understand that is to know that a bank regularly accepts foreign currency borrowings as part of its normal course of business. Now, over the last 5 to 7 years, a certain type of internal trade has become the norm amongst the treasury departments of various banks. In IndusInd Bank's case, such internal derivative trades were undertaken for foreign currency borrowings, long-term foreign currency borrowings, which typically do not have a lot of liquidity outside of what the bank currently holds. Typically, in these long-term foreign currency borrowings that the bank undertakes, it converts these foreign currencies into domestic currencies, that is rupee, and holds it on its balance sheet. Now, in the course of doing its business, what the bank essentially does is that it swaps the foreign currency into Indian currency and then buys a hedge against this conversion from the external market. Now, the internal leg of this transaction is done at a swapped cost basis, which is the cost of swapping the two currencies, and the external hedge that they buy is taken on a mark-to-market basis, which on the prevailing market rates, there is a cost that is estimated, and typically the swapped cost and this mark-to-market cost are different. Now, because it's a long-term contract, 3, 5 to 8 years, the expectation is that by the end of the contract, these two costs will converge and the bank doesn't have to actually shell out any money on top of it. This is an estimate that the bank does depending on the market conditions, and it's reading on what future liquidity is going to look like. This is what happened at IndusInd Bank, and this was normal business practice. That is, till September 2023, when the Reserve Bank of India came out with a set of guidelines which prohibit the bank from taking on any of these internal trades that the banks were typically doing. Now, according to those guidelines in September 2023, by April 2024, banks had to get rid of these internal trades from their balance sheet. What IndusInd Bank found in October last year, actually, is that some of those trades were still active on its portfolio, and that to unwind these transactions, you would have to end up paying a lot of costs, and that cost is what the financial impact that the bank is describing is, roughly 1,500 to 2,000 crore. And this is why IndusInd Bank is currently on the dock. It is also coming at a time when IndusInd Bank's CEO, Sumant Kathpalia, has only been given a one-year extension by the Reserve Bank of India, as opposed to the board's request of a 3-year extension. And this is adding up. All of these negative news points are adding up and resulting in the stock falling about 20% during the day.
And following the announcement, IndusInd Bank, through a con call, issued a clarification last evening. And here's what MD and CEO Sumant Kathpalia had to say. Listen in.
I think very difficult to answer this question. We have done all our due diligence when we've come and disclosed it. I think it's an estimate right now because the validation is still happening. And as the validation gets completed, we will come and disclose the number. In my view, I think the number should not be so much difference. It should be range bound, like you said, but very difficult to answer that question accurately right now. RBI continues to do thematic reviews in an organization. So they continue to KYC reviews, they continue to do loan asset reviews, they continue to do microfinance reviews, they continue to do credit card reviews, they continue to do corporate bank reviews. So it's an ongoing process with RBI. To say that I think there is nothing material right now which is happening to my knowledge, and I don't think we are to be worried about.
My colleague Vishy, in fact, spoke to the sources within IndusInd Bank who clarified that the discrepancies, while confirming that it took time to conduct checks. Vishy, can you give us more details here as well?
Okay, so what sources are telling NDTV Profit is that, well, IndusInd Bank is a large private bank, and as part of its normal course of business, it conducts large treasury operations on its book. Now, according to Q3 disclosures by the bank, the cumulative notional value of derivative contracts, foreign exchange contracts, and well as options adds up to about 15 lakh crore. Now, remember that this is only a notional value. The risk-weighted assets against this notional value is only about 17,000 odd crore. Essentially, what the bank has said is that the size of the discrepancy that was found and the size of the trading book that it holds is not comparable at all, and the discrepancies are actually very, very small. And this is probably why the bank was not able to detect these discrepancies sooner than it did in October of 2024. And now that it has found these discrepancies, what the bank is actually doing is that it has already informed the RBI about the discrepancy. B, it had undertaken an internal review which concluded recently, and that is why the bank is able to tell you what the financial impact is. And the third part of this transaction, the third part of the moves that the bank has done is that it has appointed an external agency to validate its own internal findings. The external agency, which is PwC, that is what sources are telling NDTV Profit, PwC will submit its report on its findings by the end of this month, and then the bank can come out with further details if necessary. The bank is widely expecting that the impact of this entire transaction, that it is estimating about 2,000 crore, that is unlikely to change by a lot, maybe marginally here and there. That is roughly around 2,000 crore worth of an impact is what the bank is expecting. Because of this, Q4 is likely going to be a very bad quarter for IndusInd Bank, and the bank is expected to report a net loss. That is what analysts are estimating at this point in time. Sources are also saying that while the RBI has not given any direct instructions on why exactly they gave Sumant Kathpalia only 1 year versus 3 years that was sought by the board, the the very decision of altering this extension points to the fact that the RBI is probably not appreciating Sumant Kathpalia's leadership at the bank. And now it's up to the board to decide whether they need to look at any external candidates or internal candidates as potential successors for Sumant Kathpalia at IndusInd Bank.
Right, Rishi, thank you so much for getting us all those details. But needless to say, brokerages have issued ratings downgrades on IndusInd following the announcement of the fiasco, and while others have issued steep cuts in the price target. Mika is joining us to give us more details. Mika.
So we've had a slew of brokerages that have downgraded the ratings. Kotak from a buy to a reduced, Prabhudas Leeladhar from a buy to a hold, Nuvama from a hold rating to a reduced rating, and MOSL from a buy rating to a neutral rating. Even other brokerages like ICICI, DAM Capital, Elara Capital, Equirus, and Anurati all have downgraded the stock. We've also seen a 23 to 39% cut in target price. The lowest target price has been set by Nuvama at 750 rupees, while Kotak has it stated at 850 rupees. And it's just key to note that the current stock price of the stock is lower than even the reduced target price. Now, lastly, what are brokerages saying? Well, Citi has also cut their earnings estimate for IndusInd Bank by 25%. The derivative position discrepancy could knock the earnings as well as net worth for the bank, and the recent developments have raised the risk perception. According to Macquarie, the current issues raise question on internal processes as well as the robustness of the bank's internal process and as well as compliance. And lastly, you have Morgan Stanley, which has stated that the visibility on the stock continues to reduce. They do see downside risk to the numbers post the company's disclosure and await for further clarity on the discrepancy.
Right, Megha, thanks for getting us all those updates with respect to what brokerages are making. But earlier in the day today, NDTV Profit also spoke to Neostrat's Abiza Divanji, and here's what he had to say on the bank's turmoil. Listen in.
There is a regulation lapse for sure. I'm not sure it's a governance lapse, but it's certainly a regulation lapse because as Vishy just explained, when the RBI circular came in, RBI basically said you cannot hold open positions in foreign currency assets that you take, and you have to hedge them. And rightly so, if you hedge them, you would not have an issue. Now look at the IndusInd problem. Either is it an oversight or is it a conscious management decision not to hedge and make some money out of a dollar position? Is the question that I guess the bank's management would have taken a decision in contravention to the regulation. So leave the regulation out for 2 minutes. The bank would have expected that if I have a position, and assuming this is all known and this is not something that was inadvertent, the bank would have said, yes, I'm holding a position and trying to unwind it. And of course, the 2023 circular kind of was not followed, would have been. In return to that, what happened is that we had a massive tumble of the dollar in the last 1 year. And that clearly has impacted or triggered the mark-to-market situation. And so it's a bet which has gone wrong if you leave the regulation aside. Now coming to the regulation lapse, whether it is a error on the part of the bank's management and the external agency will decide who the error was on, or whether it is a conscious open position taken by the bank in contravention of the 2003 regulation is always going to be a debatable issue, which I don't think will get resolved. Governance is if nobody knows what happened to that exposure and because of which the bank may end up losing 1,200 crores. That is a governance issue. That somebody just did not know what was happening. The other issue is a regulation lapse to say that I knew a regulation existed. I knew that there was a position in the bank and that position was consciously held because I thought the dollar would move the other way. Basically. So that's how I would differentiate between the two. What is right and what is wrong are again two different issues. But what I would very consciously want to say is that either which way it's a regulation lapse for sure. The governance lapse, I think, is a slightly bigger issue. That if one does not know what is happening in the bank, and that can be linked to the fact that, does a CEO get a 1-year term or a 3-year term? So I'm just trying to, kind of combine both these things and say that, yes, banks which are currently trying to deal with profitability, some of them may have taken those decisions within their ambit. Some of them may have been, taken to say that this is a currency position I wish to take over a period of time. And there's an RBI circular, which is ultra conservative in a sense that it requires every position to be hedged. And it basically tells the bank not to take any foreign exchange exposures, which may or may not be a correct regulation, but at the end of the day, it's a regulation. The problem is the differentiation we need to make is whether it is a lapse, as in a management lapse, oh, I did not know the circular, or I knew the circular, but I wanted to take a conscious move.
And that is all that we have for this edition of KYC. Stay tuned in for more. We'll be back in just a bit.